Hello everyone. Welcome and thank you for joining our webinar today. I am Khushbu from MyTime Equity and we are happy to have you with us today. In today's webinar, along with Sudhir Pai, we have with us Anup Naik from MyTime Equity. Before we start the webinar, I would like to take this opportunity to introduce you to, to Sudhir Pai. As an actively managed IRA firm, MyTime Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, let me take you through the disclosure slides that our attorneys mandate that we show prior to every webinar. If you have any questions during the webinar, please type them into the question box and we will address them during the Q&A session. If you need Sudhir's help, please write to wealth@mytimeequity.com or you can call us at 972-330-2771. Over to you, Sudhir.
Thank you, Kushbu, and good morning to all the viewers who have joined us today. Thank you for taking the time on a Saturday morning. So let me start with the recap of what happened in the equity markets and the crypto markets last week. And the title of this presentation today is "Buy the Dip or Wait It Out." About the market in general, what happened? The markets were green on a weekly basis. The S&P 500 gained 5.7%, Nasdaq gained 7.4%. Bitcoin was down a little bit, kind of flat at 83.8K, and the gold was up by around 7%. Gold has been rising and it's been doing very well. And one of the reasons for that is because gold is being accumulated by most of the governments out there, primarily China and Japan. And one of the topics that I'm going to cover in today's webinar is also about crypto, because we have launched a digital asset fund, and we are going to speak about what it means and what is in it for you to invest in that fund. So Bitcoin was flat, and we expect it to be doing well next week because, as I mentioned, with all the tariff news that is going on, and President Donald Trump gave a 90-day moratorium, for the reciprocal tariffs that he had launched on the Liberation Day, uh, and that 90-day pause has made countries to think and to negotiate with the US. So a lot of negotiations are going on between US and all the countries on which tariffs have been initiated. There is going to be a lot of discussions, and that discussion translates to changes and tweets and noise on the news channels, and all of that is reflected in the price of stocks and bonds. And that volatility, which is up and downs of the market, is very high. And we have seen, what happened this week, where the markets kind of came back up, with a great bang. But on Thursday, it fizzled out. And yesterday was kind of a flat day for most of the day, but at the end, it kind of started picking up. And one of the news that we received this morning is Donald Trump's recent change to not putting any kind of tariffs on smartphones and semiconductor chips and a few other things, which actually may give a big pop to shares of Apple on Monday morning. So, there is a lot of song and dance going on, and all this is going to certainly create a lot of fear and panic and excitements on few days. So my request to, all my viewers, supporters, listeners, clients, not to react, not to get panicked. But as a company, we took a decision of moving out of risk assets to the tune of almost 45% last week, and put that money in treasuries. And the logic behind that is because we want to buy the dip. Is this the dip to be bought? May not be for all your money, but it's always the answer to that is it depends. As someone who is sitting with cash for the last 3 years, fearing the market that it's at its all-time high, maybe it is a good idea for you to slowly get in the markets, right? For someone who is already in the market from last 3 years, made close to 50% return, we decided to take some chips off the table because of that. We did not want to keep those gains and the capital in the market and see it tanking. So we moved a good 45% to treasuries. And last week we added another 5% of that to metals and crypto. So we put some gold, silver, copper, and Ethereum and BTC, for the to the tune of 5%. So we are right now at 60-40, 60% in risk on assets and 40% in treasuries. And we will be looking to buying the dip further because as you can see on this chart, we are still below the 200-day moving average. And we think, the market can go low as 4,600 points, which has been the, support for some time, for a few years now. And on the upside, we want to get a clearance on the resistance level of 5,400 and 5,500, after which I think we'll start putting a lot more money back in the equity markets. So, it's wait and watch, go slow approach. Don't get too excited, don't get too fearful. Don't buy at highs and sell at lows. If you need help, with the managing your portfolio actively in a diversified manner, then please reach out to us. We'll be more than happy to educate you and help you as well. Next slide, Khushbu. Okay, so regarding the tariffs, now Donald Trump has decided that there is going to be tariff. That thing is very clear. And the decision is to have tariff on all the countries, not just one country or two countries. The target right now looks like it is China because China has uh, been the global supply chain for all countries, and that tariff is very important on them because I don't think there is a way to get out of China dependence. But if there is a negotiated tariff with China, as well as some other arm twisting that can be done in terms of releasing a little bit of pegged yuan versus dollar, trying to buy more of our treasuries, and trying to put some regulation on child labor and open up the borders for American imports. All of that, if it happens, then I think that negotiation with China is going to be successful, and that can really pop the market, but we don't know when, right? But I think eventually that's what is the plan. Use this tariff for keeping it permanent, but negotiate it in such a way that our fiscal, expense deficit starts coming down. Because, Donald Trump's only objective right now is to get US to be self-sufficient, to be budget surplus at some point, and to reduce the deficit that we have as a country and which has been accumulating from the last 20 years. Now how is he going to achieve all this? One idea is tariff, second idea is cutting governmental expenses, and the third idea is to start industrialization back in the US. Now, the third point is extremely hard to achieve because what you've done over the last 30 years cannot be undone. But I think certainly there is a way to kind of slowly bring things which are very, very important, like robotics, and building of semiconductor chips. So using technology, using AI, whatever can be done in the United States with the high quality intelligent labor that we have, and bring some of the industrialization back. That's the goal. But as a narrative on all the news channel, what you get to see is that Donald Trump is trying to reverse all 30 years action. Nobody can do that. Neither I think he is as dumb as that to completely undo that. Because keep in mind, this guy is a business owner from last many, many years. So he is going to negotiate hard, but I don't think he is going to do anything that stupid, or the administration will allow him to do things that are that stupid. But it's a wait and watch. Certainly, what he is trying to do is good for the economy in the long run, but short term, there is going to be stress, pain, and volatile equity markets. So, tariff is here to stay. I think the way market is kind of anticipating it is to be between 10 and 20. In my personal opinion, it cannot be as high as even 10. But like how we all pay sales tax on everything that we buy, right? You pay 6.25 or 8.25% sales tax. So the question is, why can't US charge some kind of tax on everything that comes in? So I think tax will be there, which is good. And all this will help in lowering income tax and estate tax for Americans, which is a good thing, right? Because if corporate tax and income tax for all individuals are brought down further, and there is an extension of the Tax Cuts and the Jobs Act, which was signed off in law in 2017. If that law comes back extended, I think there is a lot of opportunity for those who are making very less income or very high income to save a lot more money in taxes, and that is going to give a boost to the equity markets. So in my personal opinion, I think between now and June, July, before the tax cuts are announced, we may see a lot of volatility, but I think there is a potential for us to see one more all-time high. And after that, I think, the sell the news event will happen, and then, market can get further beaten. And then you will see a upside in the months of October, November, and December. That's my personal reading of the market. But let's see how it goes. Everyday tweets make a lot of difference, and volatility is something that we have to manage very, very actively and uh, uh, you know uh, watch it and do that on a daily basis. Next slide, Kushbu. Okay, here is a slide that gives you an idea on what happens during the first 64 days of the year, second 64 days of the year, and the total, calendar year. So the first 65 days, as you can see, all those years that are highlighted from 1957 to 2020 were negative. 2020, because of COVID, saw a huge drawdown of 21%. But the last 65 days is usually where the markets are usually green, because last quarter is when the year ends, budgets are kind of met or not met, books are all cleaned up, and there is usually positive sentiment, just before the holiday season. Holiday season creates a lot of business, like for Christmas and Thanksgiving. So all of that put together, you will see most of the time better Q4. And Q1 and first part of Q2 are usually low months, because particularly March and April, because April 15th is the tax deadline to file taxes. And when people have to pay taxes, they do sell their portfolio to an extent and pay the estimated tax or the final taxes to the IRS. So April 15th and October 15th, are the two tax dates for original filers and for extension filers. And there is usually, liquidity going to the IRS, and that creates some cash outflow from the equity markets. And usually those months are also low months. And November, December are usually good months. So that's why you see more greens on the last 65 days to the year end, and more reds, in the first 65 days of the year. So, what this says is the average returns, are pretty good, but there are different returns coming in for different quarters. That's called seasonality. So it is the right thing to be invested in the markets all the time, but be a little active as to when to keep cash on the side to buy the dip. So, we are of the opinion that the dip is not something where we take all our money and put in the equity markets now, but it has to be planned well and based on your personal risk tolerance and cash availability and goals for your life. If you are someone who needs a lot of money for your, kids' education, you can't put all the money in that equity market and, assume that, on the day you need, markets will be high. Because when you need money, markets will be low, then, it becomes a problem for withdrawing that money out of the market. So there is a bucket for every different thing. There is the emergency money bucket, there is the short-term budget, there is the moderate mid-term cash flow, and the long-term cash flow. You have to keep all that in mind, and that's what we do as a company. We help you with financial planning, where we look at what is your income, what are your expenses, what are your assets, what are your liabilities, and then come up with a financial plan and guide you to make investments in the right asset class. And that happens to be one asset class is the public markets, and the second asset class is big asset class is the alternative investments. And within alternative investments, we have real estate, we have private equity, we have private credit, then we have private ventures, and then a bunch of structured notes, which are again based on equity, but with the downside protection and upside, potential for generating certain types of returns. Next slide. Okay, here the slide talks about the growth expectations, and that has been challenged a little bit because of the tariff that is the talk of the world right now. So S&P 500, originally the expectation was somewhere between 11 and 17%. And now it is kind of, it could be anywhere from around 11%. So we are expecting the tariff to have an impact of about 7% on the S&P 500's EPS, and that's kind of where the market is kind of taking a beating, and it is trying to be at the fair market value of the S&P 500 companies. So this will keep changing based on the news that comes out of Donald Trump's office, and that is where the volatility is high. Next slide. So, we show this slide every week, in our weekly webinars. What is going to be the news next week? So we got the CPI numbers, PPI numbers last week. This week, the coming week, we are going to see core retail sales and the oil inventories and initial jobless claims. So April 17th, initial jobless claims is going to be an important number because inflation and the employment claims number will really guide the federal government, in terms of deciding the interest rate cuts. So right now the equity markets are factoring in anywhere between 2 and 5, more towards 2. But I think with the CPI numbers uh, where it is kind of coming down, inflation is coming down. Hopefully, we should see more towards 5 cuts, but that's not kind of factored in the equity markets right now. So a clarity on interest rate cuts, clarity on tariff, clarity on tax cuts, and clarity on the overall the budget of this country is going to make or break this market, and that is where watching this news, understanding the impact of this on the micro and macro economic scenario will help us manage portfolio in a more active manner. Next slide. Okay, about our portfolio management, portfolio performance, as I said, uh, equity markets were green. We saw S&P 500 around 5.67% up. The year to date is negative of 8.62, and gold was a clear winner for the year so far, 23% up, and for the week it's 6.51. Nasdaq took a bigger beating for year to date. It's around 11% down. But if you look at our models, which is on the right hand side under custom models, uh, we were about half of what S&P was. That is because we are sitting in treasuries trying to buy the dip whenever the dip happens. Time will tell. We are still bearish because of the technical indicators and the macros that we are seeing and the changes to tariff news that's coming out on a daily basis. We are going to monitor that, and we are going to get back in the markets, in risk on assets at the right time. Right now, we are at around 60-40 split, 60% in risk on equities and 40% in short-term treasuries. So we are sitting with dry powder, to latch and buy all those, assets at hopefully much lower price than what we sold it for. Next slide. So we launched this new structured note. This structured note is on Apple, Amazon, and Broadcom. all three solid companies. This structured note is dated April 14th. So this structured note also has something called as a look back feature, which means after the trade date of April 14th, we lock the price which is the lowest of the next 10 days. Now, why did we include this feature? Because markets are in a bearish trend right now, downward trend right now. So we thought adding that feature is going to help us to get the best price, not just April 14th price, but the best of the 10 days after that. So if April 10th, 14th happens to be the best price, then we get that. Or if the market corrects after we lock the rate of April 14th, then we get the lower price. So this is certainly trying to get some, lower cost basis if the market goes down. So one feature that we added, good for you to know about this feature, because knowing about this will help you in understanding, how much of thought process we put in these notes, right? This note is issued by BBVA Bank, and the maturity of this note is 5 years, and the bank cannot return you the money for at least 1 year. So unlike a CD, which usually earns around 4.55%, you are always trying to cancel that and take the money, and usually there is a lock on withdrawal. 6 months, you can surrender, or you can't surrender it for 1 year, or there is an additional fee. With our notes, it's very liquid. You can get out of it anytime if there are situations which warrants you getting out. But otherwise, we are holding this note in anticipation of holding the note for up to 5 years if the market tanks. But otherwise, this note is going to return the money back to you at the end of year one if all the three stocks, which are Apple, Amazon, and Broadcom, if all the three stocks are flat or positive at the end of year one, then you get 27.5%. If it is not, then it goes to the 18th month, and if it is flat or positive at the end of 18th month, then you get 41.25%. So it keeps adding 27.5% for every year. That's why we call it the snowball note. Now, the worst case is if in 5 years, every 6 months, at the end of every first year, end of first year, end of 6 months, and it goes all the way up to 5 years, and every 6 month, the stocks are not flat or positive from the April 14th price, that is when you will hit the real risk. The risk is you have protection of 40% on the downside at the end of the fifth year, which means if three of the stocks, one or three of the stocks don't go below 40%, in the fifth year from the first year, then you get your money back. If it goes below 40%, that's when you lose money. So let's say in this example, Apple stock is down in year five because all the three stocks did not perform for all the 5 years, and it ended up going to the fifth year, and Apple is down by 60% in the fifth year, then you end up getting only 40% back, because if once it is below 40%, then you will lose 1:1. So that is where the real risk is. Now the question is, how many of you think that all of these three stocks is going to remain flat without any upside for 1 year, 18 months, 24 months, 36 months, up to 5 years, 60 months? And if any of those, conditions of not being positive for all 60 months is true, that is when I don't suggest you invest in this note. But we are super positive about these three companies. These are three best companies on S&P in the SN list of S&P 500, and they carry major weight within S&P 500. So if these three companies don't grow or go down and keeps going down for 60 months, we have a bigger problem, right? So looking at what is practical, looking at the strengths of these companies and the combinations of these companies and the bank and the structure that we have created, which is 60-month note with a very high return of 27.5% per year, I think this note really is a great note, and you can look at putting some of your money in this. The minimum to invest in this is $25,000. But if you are looking to start your journey with us, we are open to talking to you about going a little lower than $25,000. So talk to us because this note does not have a lot of time. The date has to be April 14th, and after that, even if you wish to invest, there is no way I can let you invest because this note has an expiry date for placing the trade. And we place trades within Charles Schwab account. So you have to open a Charles Schwab account at least 3 days before April 14th. Deposit money in it so we can place the trade. So please reach out to us if you need help. And please join our WhatsApp group. You can scan that QR code that is on the screen to join our WhatsApp group. Now, if you join our WhatsApp group, we keep posting these structured notes. We keep sending you information about the equity markets, and we also send you the recording of this particular webinar. So please join the WhatsApp group if you have not joined our group already. There is no cost. It is a one-way street. Just we post messages about the market and about these opportunities. So join our group and be aware of what's happening in the world of finances. Next. So I show this slide every week just to give you an idea on how your wealth has to be diversified. We have, put money in public portfolio to the tune of 50 to 70%. Exactly what percentage, that depends on the financial plan that we create for you. And we say 50 to 70% because it also depends on your age, your family profile, as well as your goals for your finances. 20 to 30% in real estate, 5 to 15% in private equity and ventures. That's the kind of breakdown we suggest, and we can create a plan for you if you talk to us and give us a complete idea of your income, expenses, goals, assets, liabilities, global assets. We can kind of create a portfolio for you and 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 give you the details of that portfolio so you can then tell us whether you want to move forward with that idea. And a few slides that I'll show you after this. First one is going to be private credit. Second one is going to be infrastructure fund. And third is going to be the newly launched digital asset fund, which we are going to talk about in the next few slides. Next slide. And by the way, uh, April 15th deadline is not too far away. So, if you have not planned your 2024 tax returns, if there are opportunities to save your 2024 taxes, we can talk to you about it. We have few ideas in terms of for business owners, for individuals. So if you need help, please reach out to us because we may suggest filing an extension and taking those actions to lower your 2024 taxes. And coming to tax planning for 2025, we have few ideas already in place. You can reach out to our team. We are very comfortable in lowering your overall tax by about 50%. So, talk to us to understand what it means to lower your tax by 50% because every action that we take has consequences. It has consequences in terms of cost and in terms of risk reward, right? How much risk you take, that much reward you get. How much reward you want, that much risk you have to take, right? So with that, let me quickly show you this one slider on digital asset fund. This is called as the My Time Equity Digital Asset Fund, or in short, MDA. This fund I am going to present in detail in some time. But the idea is this fund is going to be a diversified fund invested in multiple asset managers who are dealing with cryptos and digital assets in the US. And we will be investing 70% of the fund's money with these asset managers. And these asset managers have multiple strategies such as long, short, and uh, buy and hold. And this fund is a very liquid fund. Money is available 24 bar 7 for us to exit. But for the fund, we have a 1 year hold because we don't want you to invest and take it out, in less than a year. because it affects the fund's performance if you intend to take it out very soon. So this is a good fund for those who want to invest for at least 1 year. And the redemptions, meaning you can take your money back if you want to after 1 year by by requesting for it, and that redemption can be done once every quarter. Now, what are the returns that we are trying to target for the fund? We are trying to target a very high return because the risk is very high in terms of volatility. Because anything you talk about digital, whether it is assets or ventures, digital ventures or digital assets, it comes with high volatility because of the high liquidity and marketability it has, and also because of the nature of the asset, because it's extremely speculative in nature. So I'll take you through the digital asset fund in some time. Let's go to the next slide, Kushbu. So take a look at this. This is not at all volatile like the digital asset fund. This is super non-correlated to the S&P 500 or the equity markets. This is called as the infrastructure fund. This is not the fund that I have created for myself or my clients. This is a fund in which I am investing and I'm suggesting that you to invest. This is from a company called Ares. Ares is a $525 billion organization, listed company like Blackstone and KKR, Carlyle. They have this infrastructure fund which gives 10.7% cash flow every year, and they pay this money on a quarterly basis. And the money that they pay is not taxable because it is treated as long-term capital gain when they return the money back to you. You can request for money back from this fund any day, anytime. But if you request for it within 1 year, there is a 2% redemption fee. But after that, there is no fee and liquidity can be made available every quarter. The minimum to invest in this is $25,000. You have to be an accredited investor, which is something that you don't need to be for structured notes, and the monthly payment goes directly to your Schwab account, and it's around 10.7%. Last month was 10.8, and it is, since it is not taxed, the tax effective yield is like around 12.84. So if you get something like a CD, interest on CD, and if you have to pay tax on it, that brings down the effective rate for you. But here there is no tax, so you can think of it like 12.84%, but net of tax, you're getting like about 10.7%. But the cash flow that you're going to get is between 10.7 and 11. Last month was 10.8. So it's paid every month. So in my opinion, this is a very good investment idea because the average of S&P 500 over last 10 years is between 10 and 12%. So, if you're getting to invest in something like the Ares Infrastructure Fund, which is such a large fund, which has liquidity, and you're making income of 10.7, which is not taxed as regular income, but taxed as capital gains, I don't think there is anything better than this, right? But please reach out to us if you need help, and we can send you all the reading material, the ppm and the prospectus and all the good stuff, so that you can make a decision to invest in it. Next slide. Okay, so I request you to post your questions in the Q&A box, and we'll take your questions after a quick presentation of our digital asset fund. So this asset fund is launched by My Time Equity, which is our registered investment advisory firm. We have a sister company called My Time Equity PE, which is private equity. So My Time Equity PE deals with real assets, which means real estate, such as land, buildings. In buildings, you have multifamily, you have office, you have commercial, all different types of real estate. And on the digital asset side, we deal with assets such as Bitcoin and other large cap coins such as Ethereum, XRP, Solana, Cardano, and multiple other coins that are created on layer 1 and layer 2 of the blockchain or Web3 that is going to be the technology of the future. So for those who don't understand what digital asset means, I am going to explain to you in detail what digital asset means, what Bitcoin means, why is Bitcoin the way of creating generational wealth, and how is our fund, My Time Equity Digital Asset Fund, using digital asset to grow our wealth. So we are going to talk about all of this in the next few minutes. Next slide. So we have the agenda. We will go to the next slide, Kushbu. So with the digital asset, I think we are at the cusp of creating generational wealth. You know, my clients come to me and ask me, what is that one asset where I can make a lot of money? I know with bank CDs I can make 4.5%. I know with stock markets I can make between 10 and 11%, but with extreme volatility, up and down, up and down, up and down, panic, going up. You don't know when it's going to go down. It's highly liquid, volatile and liquid. Real estate generates between 8 and 20% depending on are you getting into a stabilized asset, a multifamily asset, student housing home, or in oil and gas wells, you get between 15 and 20%. In gold, you get anywhere between 8 and 22%. So it's kind of varying, right? But what is that one place where there is an opportunity to make a lot of returns? But keep in mind, when you try to chase lot of returns, there is also a lot of risk. But the good thing about Bitcoin is that it is limited. What else is limited in the world, which we all know from many, many, many decades? It is land. Land on earth is the only scarce asset which you cannot produce, correct? Every other thing you can produce. Gold, if you find a new mining, field, you can mine it and you can generate more gold, right? Because you mine, and if there is gold, you can take it out, you can make bars or bullions. But for Bitcoin is the only other asset which is scarce, because the way the code is written, the white paper is written for mining Bitcoin, it clearly says that you cannot mine more than 21 million Bitcoins. And this is a white paper that was written about 15 years ago, and the person is anonymous. Nobody knows who the person is. Many of them have claimed to be Satoshi Nakamoto, the person who claims himself to be the founder of or the creator of Bitcoin. But that person, nobody knows who is. And that white paper has been used to generate Bitcoins. And over the last 15 years, so many people have tried to break this code, and they have not been able to beat or break this particular code. So it is now a very, very well established, asset class for the institutions also to invest in Bitcoins. And I'll take you through those slides. But why is this a generational wealth opportunity? Because what is happening in the markets? We all see news every day. There is so much of issues going on with other countries where the countries are saying we are tired of dollars. Let's start buying gold. What did China do last 3 months? They've been buying gold, 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 right? Because they all are trying to see how do we, diversify, or how do we try to remove the impact of dollars on our life, right? So they are moving towards gold, but gold again is something that you can touch, you can feel. To store it, it takes a lot of space. Somebody can attack that space and take away all your gold. It costs money to store gold. So with all that, Bitcoin, which is extremely liquid, 24/7, the markets are open for Bitcoin and cryptos, and it is a digital asset. And the code is written in such a way that you cannot break the code. And there is only 21 million Bitcoins. And institutions have adopted, digital assets, and we'll talk about how are they monetizing or adopting digital assets. And there is a lot of momentum across the world. So Europe and the Middle East has been investing so much in the digital world, in digital assets. They are very, very friendly digital economies. And US, after President Trump has taken over, the main person who is appointed for as the crypto czar, David Sachs, there is a lot of realization in the current administration that Bitcoin and other digital assets are here to stay. Blockchain is the next technology which is going to be the prime technology. We will be moving away from websites and Web 2 to Web 3. So we are at that point where it used to be like 1990s for the internet. What happened in 90s? The internet started, all the pipes were laid throughout all the oceans. Internet became the name of the game. Every household had internet. From there started Apple phones, then started apps, and from apps, Amazon and all got maximum business. They are all grown to be, Magnificent Seven. From there started EVs. From there started robotics. Now there is the AI thing going on. So with all of this, we are going to see huge technological change, and AI plus blockchain is going to transform the world. Okay, everything is going to be very different 10 years from now. So it's very important that you have some of your money, not all, some of your money in digital assets. And that is the reason why I have created this digital asset fund. I created this for my own investment. And then I thought, why don't I take advantage of my clients, my ecosystem, and take advantage of using that negotiating power with the asset managers in which we are going to invest. Okay, so the other 2 points that I would like to make about why this is a way to generate a lot of wealth is because the real assets like the land, the companies, the shares, the bonds, all of those assets are going to be digitized, particularly the real assets. If you are able to digitize your building, if you are able to buy 1 square feet of Times Square building in New York, that's going to generate a lot of liquidity in the market, and the real estate boom is going to come. Because as you bring liquidity for every asset class that is illiquid today, the markets expand. Correct? That's what has happened over the last 10 years. If you really see the whole expansion of the world from 1990s to 2025, particularly from 2000 to 2025 and 2002 to 2025, even though there was a global financial crisis, even though there was a COVID, the way you've seen the world grow since 2002 to 2025, this has been phenomenal. And that world is going to grow further with AI and blockchain. And what blockchain is, it's the technology, and what is riding that technology is the token that is required for building applications on that technology, because this technology is based on open source, and the developers who use open source need to be incentivized, and the incentive to those developers is the tokens that we are planning to invest in through our fund. Okay, last but not the least, it's a store of value. With all the inflation and scarcity narrative that we get to hear and we get to see, Bitcoin, because it has only 21 million units, there is a it's a very scarce asset. And like land, this asset is only going to grow. Okay, so there are only two scarce assets. One is gold, and one is Bitcoin, which is the digital gold, and the second is land. So within gold, there are two, the real gold and the digital gold. The real gold, you can mine more if there are mining opportunities in other parts of the world or in Mars. If Elon Musk finds a lot of gold in Mars, again, gold prices can go down. But Bitcoin, you cannot create or recreate except for the 21 million units that can be created, and most of them have been created. Next slide. So why is this such a big opportunity? So digital assets if you can look at the screen very closely, the total market capitalization of real estate is at $600 trillion dollars, and the debt market is 235, and the commodity market, which includes all the kinds of commodities like gold, silver, and all other commodities, is about $128 trillion dollars. And global equities, which is made up of all the S&P 500 companies, stocks, bonds, mid cap, small cap, that's $109 trillion dollars. And digital assets is only $3 trillion dollars. All the digital assets put together has grown to $3 trillion dollars, and the potential for that by 2030 is to grow 8 times, or $25 trillion dollars. Okay, today the market capitalization of gold is around 21, between 21 and 22 trillion dollars. And we are believers, like many other believers, many other professors of all the Ivy League colleges, there is a huge belief that Bitcoin is going to touch $25 trillion market cap by 2030. Okay, so this is the opportunity that we are talking of. Next slide. So coming to crypto adoption, Bitcoin has been is being mined for many years. As I said, the asset class is proven, and it is growing. It's crossed $3 trillion dollars from the last few weeks. We have seen all asset classes tumbling because of the global uncertainties, because of the geopolitical tensions and the trade wars that are going on. But if you look at the performance of Bitcoin versus S&P 500, real estate, and debt or fixed income, the performance has been huge. Bitcoin has performed 120% over the last 10 years average. Whereas S&P 500 is around 10 to 11, real estate is between 10 and 20, and fixed income is around 5 to 6%. So you see how this asset class has performed. Now the question is, if the last 10 years since the first coin was mined till now, if it has given a 120% return on an average, what is the future? The future is going to be much more, less risk compared to the last 10 years because it's a proven asset class now. But the returns is going to be not as high as 120% maybe, but it is certainly not going to be like S&P 500 because there is a lot of education, lot of adoption, and lot of technological innovation that needs to happen for the digital assets to really go very high. And that is where, this is a place where you can create generational wealth. Generational wealth means wealth that you personally don't enjoy, but it is enjoyed by future generations of yours. Your kids and your grandkids, they are the ones who are going to see a ton of money from your investment today. If you can think of, if you are from India and if your parents had bought a lot of land in India for you, they never got to enjoy those real estate, right? You are today, reaping the benefits of the real estate that your parents might have purchased, or your family might have purchased, or if you might have purchased. If you are, at the age of 50 plus, and if you had bought some lands when you were at 30, what is the price of it today, right? It is really huge. And why is all that? Because of the way the world works, right? Inflation, money printing, growth, and all of that, right? So digital asset is proven from the last 10 years, and I personally think that it is going to do extremely well in the next 20 to 30 years to come. Next slide. Now, to give you more confidence about digital asset fund, because one thing that keeps coming up is, hey, digital assets, you can't touch it, you can't feel it. Can you feel the internet? No, right? But you are using internet. Can you touch and feel the app on your iPhone? No, but you can still use it, right? So similarly is any other digital asset. And now, as you can see, the institutions are investing in digital assets, and lot of money has flown in the ETFs that have been created by Blackstone, Fidelity, Franklin Templeton, and 8 other ETFs. And all these ETFs put together today is in excess of $50 billion. When it started, it was around $36 billion. But today, it's huge. It's crossed $18 trillion actually. But when they started on day first 1 week, I think the total money that they got in these ETFs was about 36 billion, and today it's crossed $18 trillion. So you can see the way money is flowing in the digital asset space. Once everyone invests in digital asset, then it becomes a normal asset. So the time is now. After the institutions have shown confidence, there are ETFs and more ETFs are coming. Then comes Donald Trump. He gives more importance to regulation of the law, gives more importance to blockchain, appoints a person like David Sachs as the crypto czar. So when all the trends are going towards, the digital asset, it makes a lot more sense to get in at this point, right? I am a super conservative guy, but I am conservatively aggressive, right? Which means I don't want to be the first player, putting my money in this. But today, 15 years later, when ETFs are created and there are trillions of dollars going in those ETFs, the question is why you should not be putting some of your money in digital asset space. So if you look at my portfolios on our website, mytimeequity.com, you can see that there is a portfolio called metals and cryptos. And that model has Ethereum and Bitcoin. And most of our clients are exposed to digital assets through the public ETFs. But why are we looking at this fund is because there are so many ideas in making money for using the digital assets. And two, there are also so many other tokens or digital coins that can be used for investment. These are all like large cap coins. So even in coins, there are three types of coins. There is large cap, mid cap, small cap, and meme coins. So in this fund, it's very clear to us and the investment managers that we have chosen that they're not going to touch meme coins. Meme coins are like the Donald Trump coin that got launched one day before the inauguration. Those are it's like GameStop, as a stock, it's a meme stock. Robinhood used to be meme stock. Now, there are a lot of coins on the coin exchanges. There are 12,000 digital coins. Bitcoin is the king of all coins. It's like the gold standard or the platinum standard. And then Ethereum is a very, is a coin which is created on layer two, which is an utility layer, which means that is the layer on which applications are written. So for the ETFs, right now you have only access to Ethereum and Bitcoin. The other coins should be there in ETFs very soon, but right now there are no other ETFs other than Bitcoin and Ethereum. So that is why we felt that it's the right time to invest some of our money in multiple managers and multiple types of large cap coins, so we can take advantage of this generational asset creation and money creation idea that the world is talking about. Next slide. So, coming to giving you the background of Bitcoin itself, the total number of Bitcoins that can be there are 21 million Bitcoins, and there are only 19.9 million Bitcoins that have been mined. Of the 19.9, 4 million Bitcoins have been lost. Nobody knows where they are. And the US government has a reserve. If they find some of the lost Bitcoins, or the ones that are used in terrorism or money laundering or frauds and all that, because this is a digital coin, right? Anybody can get access to the coins that are out there. That's where we get to see a lot of cyber issues happening in the digital asset space. And here in this fund, we are not trying to buy, digital coins and put it on our pocket. We are trying to invest in other managers who invest in digital assets. And to about 30% of the money, we will host it on Coinbase. which is the institutional, exchange listed on US stock market, one of the best companies in the crypto space, which is creating the entire infrastructure for holding, for custodying, and for different purposes in the digital asset space. The last Bitcoin will be mined in the year 2140. So there is a lot of runway, and generating the Bitcoin is going to become harder and harder. So the mining companies are going to spend a lot more monies. And if you look at the holding of Bitcoins of the 19.9 minus 4, of the total $15 million Bitcoins, about 424, million, 424K are held in private companies. Governments hold about 525,000 bitcoins, and about 86 public companies hold about 665,000 bitcoins, and about 1.3 million bitcoins are held in ETFs and funds. So if you see, there is a lot of exposure to Bitcoin amongst the governments, public companies, private companies, and the ETFs. If every other American in the US starts buying one Bitcoin, I think the price of Bitcoin is going to cross about $250,000. And the estimate for Bitcoin at the end of 2025 from many experts in this field is anywhere between 130 to $200,000. Right now, Bitcoin is at $83,000. Again, Bitcoin is an asset that is extremely volatile. Bitcoin was at $19,000, in February of last year, and in November of last year, it touched $108,000, after Donald Trump's inauguration. And today it's around $83,000. So you can see the volatility, the ups and downs of Bitcoin and Ethereum. It's very, very high. So, if one looks at the price movements every day, you certainly will get the shock of your life. But if you look at this as a place to create generational wealth, you put some of your money and forget about it and get back in the account and look at it after 2, 3 years, you will have a ton of money, and that's the reason why we have created this digital asset fund. Next slide. So let me also quickly take you through this process called Bitcoin halving process, which means generating of Bitcoins become harder and harder every 4 years, because Bitcoin is an incentive given to the developers who mine the Bitcoin, and it becomes harder and harder every 4 years. So that means the price of Bitcoin is only going up because the scarcity is going to increase, mining is becoming difficult, and the limit is 21 million Bitcoins. So, the asset is only going higher and higher. And to add to that, if there is high inflation, and if there is all these issues with tariff, D-dollar, dollarization going on, high inflation, with all of this, the expectation is that Bitcoin or any other digital prices, is only going up. Bitcoin, because of the supply constraint, it has to go up. But all other coins, that depends on the utility of those coins, the value of those coins in usage for technology and other things. So Bitcoin is the only gold standard coin. So, other coins, you'll have to really look at the dynamics of that coin, the cost of creating that coin, and the utility of that coin, and then the demand and supply for that coin. That is how the valuations of the coins are on the exchange. Next slide. So coming to manager profile, we are the managers for the My Time Equity Digital Asset Fund. So My Time Equity, as most of you know, is an RIA firm managing money for a lot of its clients. And the manager managing the digital asset fund is going to be My Time Equity. And then we also have our interests in real estate and ventures. So on the real estate side, we manage a lot of assets. We manage about uh, close to about 8,000 acres of land and about 14 buildings and other assets that we are in the process of developing. And on the venture capital side, we launched a fund, US fund, similar idea. We invested that money in India in multiple different funds. So the venture fund was a very big success, and today the total value of the venture fund has gone up, even though it's been less than a year since the fund closed. So I see, if not similar but higher return for the digital asset fund, because we are dealing with the liquid asset, not something like a venture capital asset which is very illiquid. So digital asset fund is a very liquid asset, 24 bar 7 traded, and the technology of the future, trying to create generational wealth for those investors who invest in this. Next slide. So I touched on this multiple times, but a quick overview of our fund. Our fund will be investing in the top tier funds of the US, and the investment is going to be only in Bitcoin and large cap cryptocurrencies. And we will be investing in multiple strategies and multiple managers and multiple tokens. So we have diversification of all three kinds. So, we try to protect our capital as much as possible. And the kind of asset managers that we have chosen are like best of the world. And this process of selecting these managers have been going on from the last 8 months. And we launched this fund, the MDA fund, on March 21st, was the official launch of the fund. I have personally invested in it. We have many clients who are interested in investing. So it's my request to you that if you want access to digital assets, if you want access to digital assets in a way where it is diversified across managers, across asset classes, and across different types of assets and different strategies to manage those assets, then I think you will have to invest a little bit of your net worth in this fund, and you'll be doing very well. Next slide. So the management team, we are two of us, myself and Bhavya. Bhavya Joshi is the portfolio manager, and most of you know me. I have been managing multiple companies, helping you guys with your tax and real estate and equities and all of that good stuff. So today, the two of us, along with the extended team that we have in our office, we will be responsible for investment within this fund, shortlisting of managers, shortlisting of different tokens, shortlisting of strategies, and all of that good stuff. I am also certified now in the blockchain and digital assets, so that you feel comfortable and confident that not only I am a CPA, but I'm also registered with the SEC, as well as hold this certification in blockchain. With all that, I am super comfortable, super confident of putting my own money and requesting you all to invest in this fund. And we'll talk about what is the minimum in this fund and what we can do in terms of lowering the minimums for our existing clients, as we always do. So next slide, Khushbu. So the thesis of the fund we talked about, we'll be investing in top tier managers, negotiated fees, strategic diversification, and then the manager selection, which we talked about, has been going on from the last many months, and all of them have solid track record, and we are, and their track record is like really good. And 30% of the investment will be managed by us, me and Bhavya. We'll be investing that in Bitcoin and 5 other large cap coins. The reason why we are doing this is to, return your investment in case you want it. So we don't have to liquidate our investment with other managers. So 30% of the money will be available, and we have a next slide, Khushbu. We have a 1 year hold on your funds, and after that, you can withdraw the money anytime by requesting for it. What is the kind of return and the volatility and the drawdown that we are expecting in this fund? If you look at this slide, we have S&P or the SPY ETF, we have the Nasdaq or the QQQ ETF, and we have the CCI 130, which is like SPY for tokens. which it has 30 tokens, that's the index. So if you look at this, the SPY has generated 23% return, the QQQ has generated 25% return, and the coins index generated a 78% return, while our fund, we expect it to generate 86% return if our fund was in place in 2024. So this is a back-tested model. This is an hypothetical model. This is not actuals because we cannot have actual data for our fund because it's a new fund. But when we back tested, since 2018, 2018 till 2024, we see that this could be the numbers of our fund. Now, nothing suggests that past performance can be future performance, but we have to look at past performance when we decide to invest in something. So this is what we saw, and this is why we decided to launch this fund. The 3-year return is around 68%, 5-year return around 83%, and 7-year return around 48%. And the maximum drawdown, the how low can the fund go at any point of time, like how we saw S&P losing 20% for 2025, doesn't mean to say for the entire year S&P will be down by 20%. But as of now, S&P is down by that much, right? But it went up last week and now it is slightly better. But the maximum drawdown, which means at any given point of time, uh, we we are ready to see a 79% drawdown on our fund. Okay, that is why we have the 1-year lock and the quarterly redemptions. So when the market goes down for Bitcoin or other digital assets, we don't want you to get panicked and you ask for your money back, right? We want you to get educated and be with us throughout the process because we are the believers of this asset class. We know that you will get 86% return just because there is a potential for a 79% drawdown. So it's risk versus reward, right? If you are if you have a risk of 5%, you will get a return of 5. If you have a risk of 79%, you have a benefit of getting up to 86%. That's how risk reward works. You cannot say I don't want to take any risk, I want only reward. That's not there in the world, in at least today's world. So this is the high level return risk reward ratio that we are expecting in the fund, and we will try to manage it as nicely as possible to lower the risk and increase the return. That's our goal, mine and Bhavya's goal, for as managers of this fund. Next slide. So who are we dealing with? We, as you can see, we have a lot of different managers that we have talked to. As we get money in the fund, we are going to make investments in these funds. ARK Investment, as most of you know, there is a public fund for equities. Similarly, they have a non-public fund for digital coins. The minimums for that is 500K. One of the reasons why we have this fund is, our fund has a much lower minimum than the minimums of all of these funds. And when you invest in our fund, you indirectly get access to all of these funds. Okay, and then we use NAV for the accounting and administration. They will send you quarterly statements, and we have access as the bank for holding our bank account, and then Spicer Jeffries as the audit firm, because this fund will be audited and the audited financials will be sent to you every year. So you have, monthly performance, quarterly performance, and annual audits. And the banking is with Axis, and Coinbase and Abra are the two custodians that we have shortlisted for holding coins, which is for the 30% of the fund, which we will manage ourselves. 70% of the money will be with the fund managers that you see here, and that's an ongoing process. As we raise money, we will have to decide how much more to invest in different managers. So this is going to be an ongoing process for us, and this is going to be a perpetual fund. We don't expect the fund to be closed. You can come in and get out whenever you feel like, as long as your money is held for 1 year with us, and after that, it has its quarterly redemptions. But for us, it's a very liquid fund. All the managers that we are investing in have 1-year locks. That's why we have 1 year lock on our fund as well. And 30% we keep it available, still invested in case, any one of our investors have some emergencies, or after 1 year, if they want to redeem, or if we want to return the money back to our investors, because I cannot take more than 99 investors in this fund. I have a limitation from the SEC. It's a rule that I cannot have more than 99 investors in our fund. So, if I touch 90, that is when I want to decide. I have to decide when a very large investor comes to me, I have to decide who to keep and who to accept. And because of that, we have the flexibility in this fund to make exceptions in terms of returning the money early, or earlier than 1 year, or if there is some big emergency amongst our investors, we can always return money without going through the 1 year lock. But it is a decision that I have to make in terms of returning the money back to our investors before 1 year. And in terms of having to return money back to the investor in case we have too much demand. So this is one of the limitations I have in the fund. I cannot take more than 99 investors in this fund. Next slide. So coming to the fund terms, the name of the fund is My Time Equity Digital Asset Fund. In short, we call it MDA. And the investment manager for this is My Time Equity, the RIA. And the minimum investment for this is $50,000, which means if you invest your $50,000 in this fund, you get access to all the managers, all the strategies, all the different types of coins. And we are expecting to grow this asset at a very high return compared to S&P 500 and the coins index. And the fees that we charge for the fund in the fund is there is an acquisition fee or one-time fee of 3%, and then there is a management fee, and that management fee depends on how much are you investing. If you are investing $50,000 or less, if you make an exception, I can take $25,000 tickets also, but below $25,000 I am not willing to take because I have a limit on how many investors I can take. So 25 is the bare minimum investment that you can make in this fund. If you are investing less than 50K, you pay a 2% management fee. If it is more than 50, less than 250, you pay 1.5. And if it's more than 250, you pay 1% management fee. And the performance fees, depending on the performance of the fund, you will be paying 20% performance fee and 10% if it is more than 250K. Again, there is a 8% hurdle rate, which I think we missed in this slide. But when we send you the PPM to read, you will see that there is a 8% hurdle rate. Only if the fund returns all your money back and the 8% per year back, that is when we are eligible to get a performance fee. Otherwise, no. So the subscription currency is in dollars. We will not accept any other currency. It's only dollars. And the lockup, there is a 1 year hold on the fund. And after that, you can request for the fund every quarter. The fund administrator is NAV Consulting, one of the largest administrator in the US, managing most of the funds. All size funds, $100 to billion funds is being managed by NAV. It's a large firm. And the fund's auditor is Spicer Jeffrey, and the legal advisor is Dwyer Law Offices. And the custodian for the fund is Coinbase, and the bank is Axis Bank. So we have got a beautiful ecosystem around us. So the fund is going to be extremely transparent in terms of monthly reports, quarterly reports, and your annual audits. Quite liquid, quite well diversified. I am very proud of launching this fund. So if you want to make a journey, get your journey started with us, please send an email to us. Next slide, Khushbu. Please send us an email. You can send it to wealth@mytimeequity.com, or you can send it to ir@mytimeequitype.com, or talk to your account manager, and we'll be happy to get you in the fund. There is only once a month opening in the fund. We cannot take the money on every day. So every month on one certain day, maybe within the first 5 days, we are going to make it a date when you can invest in the fund. There will be a value that will be generated every month when you get in and get out. So it's called as NAV, net asset value. And let's all make money together. and be part of the generational wealth growing asset class, which is Bitcoin and other cryptocurrencies. This slide shows you all the different types of risks that apply to the digital asset world. You can read through this, and if you're interested further to learn more about our digital asset fund, please write to us and we'll send you the PPM and subscription documents and all the other stuff that you need to read. If you want a call to be arranged with me, please let us know. If you want a bunch of people all come together and invest, 250K or more, please let us know. That will help me in using my 99 seats that I have for my investors diligently. And for you, it will lower your fees in terms of management fee and the performance fee. So please connect with us, whether it is your portfolio management, whether it is structured note, whether it is private credit, private infrastructure, or digital asset fund. There is a lot of things to choose, a lot of things to invest money in. Don't get blindsided with a few people who talk to you only about life insurance or annuities or only stocks or only real estate. Here we are talking to you about everything, because everything has to be in your portfolio. It cannot be one thing, because we all believe in diversification, right? So talk to us, understand how much money you need to put in different assets, so your money is protected, your money grows depending on how much risk you are willing to take. So once again, ladies and gentlemen, thank you very much for joining today's session. We will take few questions. Kushbu, you want to uh, uh, go through the questions?
Yeah, Sudhir, I can do that.
Sure. Sure.
Thanks, Sudhir, first and foremost. I think it was a good commentary for last 75 minutes and lots of information. So let me start with since we sort of touched upon the digital assets, the crypto funds towards the end. Let me start few questions on that, and then we'll go for the rest one.
Yeah.
So the first question is, you mentioned 1 year hold and then we can request withdrawal at any time, but the slide shows quarterly. Probably I'll try to explain it here. So the way it works is similar to how our private credit and infrastructure funds is, that it is expected that you there is a 1 year hold for withdrawing the fund, but after that every quarter you can make a request. So there is a window every quarter, so you'll have an opportunity on the 15th month, 18th month, 21st month and 24th month. That is what it meant, that it is a quarterly withdrawal thereafter. I think that answers the question.
Yeah.
The next questions again is that we have seen lots of hacks and digital assets to be stolen, right? What measures did the fund manager takes to safeguard? Uh, that is other questions. So there we have.
Can you repeat that once again? Sorry.
Yeah, we have seen lots of hacks and digital stealing digital assets.
Yeah. Yeah.
What are the measures that the fund managers are taking to safeguard this, funds?
Yeah. That's a great question. A very, very important question, because that is one of the biggest risks that digital asset has, right? Because that's also the benefit that the digital asset has, because it's 24 bar 7 tradable, all the time, very easy. But at the same time, digital means more prone to attacks. Now, the asset managers that we have chosen are all like having at least 5 years of track record of performance and of strong processes. So they all have, multiple security levels to cross in terms of, trading, and most of them are accounts in the US. There are too many wallets, there are too many exchanges. My understanding is that there are some 16,000, digital exchanges. But we are dealing, and most of our asset managers are dealing only with Coinbase. That's the exchange which is listed in the US stock exchange in the US. Everything is US, and the company is doing extremely well. So we use Coinbase, and one other company that we are also talking to is Abra. That is the company that most of the wealth advisors are trying to evaluate and use. So we have taken every other precaution that every other diligent advisor needs to take when it comes to these issues, Anup.
Thanks. So there are a couple of questions with respect to the fees.
Mhm.
One is questions on performance fees hurdle rate, and there is one more question which says that are the fund managers fees on top of the manager fees? So that is the second question that we have got. So one was on the
Yes.
performance fee hurdle rate, and is there any additional fees on top of the manager fees?
Yeah. So that's a great question. Thanks for bringing it up. So there is a hurdle rate of 8%, if I'm not wrong, but we can clarify that. And second, our fund is investing in other funds to the tune of 70%. Now, those fund managers have given us breakpoints. Now, the thing that you need to keep in mind about these funds have very high minimum. So if you want to personally invest in any of these funds, because they have such an awesome track record, the minimums are anywhere between 500K to $3 million, right? Now we have negotiated with them either for lower minimums or for lower fees or no fees, right? Now the fees depends on how much money we are going to invest in those funds. So depending on our overall fundraise, our interest of our clients, that will help us lower the fees that the funds would charge. Now also think about this. You are investing in an asset which has grown at around 120% per year, average of last 10 years. Now, when you are trying to invest in such an asset, there are going to be fees that those managers would charge because they are using their strategies, their ideas, and timing, and all of that. So, because of that, fees is going to be there, and we are putting a lot of effort. That's where we have our fees, and you are getting access with as less as 25, $50,000 to invest in all these funds indirectly through our fund, and there is a cost of doing that. And so yes, there are all these fees.
Okay, thanks. So the next question I believe is already answered. With quantum computing rise, there's real threat of breaking the crypto algorithm. Any threats that you see? So Sudhir has already explained that considering the experience and the diligence that we have done to choosing the managers, so that should address the question. And then yeah, there was one question on tax returns, because I think there is no more questions further on this digital assets. On the
Mhm.
tax returns, are the 2024 tax options available even if you have filed your returns?
So we have to see, what is the kind of income you made. Amendment of return is the way to amend your already filed returns and take advantage of any planning ideas that we may have. So first thing is we have to see whether there is anything we can do. If there is nothing that we can do, then there is no discussion about amending. At least it will give you an idea on what you can do for 2025, right? Because right now we are in 2025. There is a lot of capital gain that people would have made. So we have all these ideas about opportunity zones, donation programs, depreciation programs, and all of that. So yeah, talk to us first, and we can then decide what needs to be done and not.
Okay, okay. I see there are a couple of more questions on the fund, the digital funds, which is a management fee percentage over the return. If the fund created 20% return, then 10% of that is a fee.
Yes. Yes.
Yeah,
Anything
yeah.
above 8%. So if the fund generated 20%, first 8% there is no fee, and above the 8%, on the rest 12%, there is a 20% fee, assuming that your investment in our fund is below $50,000. So if you want to really lower the fees, my suggestion is uh, put lot more money in the fund. And this is one more point I want to address. Your first investment will be supported by complete documentation, but your subsequent investment will be made just with one page form. So every month, if you want to invest, let's say 10, 15, 20, 30, $50,000, you can just fill up a form and keep sending money to the fund, and it is as streamlined as that. So the real way to lower your fees is to increase your minimums. And the good thing for us is, we can, since we have only 99 investors to take, we would like to grow this fund to a much bigger fund. So the minimums that each person puts in the fund, eventually has to grow. Otherwise, there is going to be a real challenge to lower the fees of the overall fund.
Thanks, Sudhir. As of now, I see one last question on this. How is investing in this fund different from buying Bitcoin and Ethereum separately somewhere?
Yeah, that's a great question. Now, if you buy Bitcoin and Ethereum directly, you are only in Bitcoin and Ethereum, and it's a buy and hold strategy. Now, here, what we are doing is we have selected managers who go in and out of not only Bitcoin and Ethereum, but also other large cap coins such as Solana, Cardano, XRP, Doge, Shibu, many others, right? Large cap coins. So these fund managers have a track record of generating a huge return versus just Bitcoin and Ethereum. So that is one thesis, one advantage. Second is, we will be also holding 30% of the money in Bitcoin and 5 to 6 large cap coins. So you are getting exposure to a lot more than just Bitcoin and Ethereum, which you can buy through ETFs. And last point I would like to make is when we invest directly in the coins, there are also ways to generate income by holding those assets. Like it's called the staking income. Staking income is anywhere sometimes between 1% and 10% on some of the alternative coins. And that will also help in terms of generating a higher return for our investors.
Okay, thanks. And all who are requesting for to be added to the WhatsApp group and requesting for reading material about the infrastructure funds or anything, please write to wealth at mytimeequity.com. We'll be more than happy to help you. And I see one more question. What is the anticipated liquidity? I believe that you already showed, what are the returns in 2024 and the past returns. Hopefully, that should help in giving a sense of what is the anticipated risk. But as you rightly said, past performance is not an indicator of future, but we can definitely talk about the back-tested model, right, Sudhir?
Correct. That's correct.
Yeah. Okay. One other questions before I jump into the infrastructure funds and structured notes. FINRA Broker Checks website shows only two people from My Time Equity with experience of about 5 to 6 years. Can you please comment on how much experience your team has with the product you're selling? And I believe, Sudhir, you can definitely comment with the fact that we have been adding a lot more associates in the past few months. So I think that should boost our overall experience level. Right,
Yeah,
Sudhir?
yeah. So one is, let me be very clear. My Time Equity as a company has been in place only for 3 years, less than 3 years. And myself, I have been a CPA and in a finance professional throughout my life. Getting into, the wealth side of the business was primarily to manage my own money when I had a exit on one of my businesses. So if you're looking for somebody with 10 years of track record, that is not me, right? If you're looking for somebody who has his own money in the game, that is me. And somebody who is trying to find other asset managers who have lot more experience and track record than me, then that is me. The reason why this is a fund of fund and not just solely managed by me is because we need smarter people than me in this fund. That's why we have chosen, these managers. Now, the reason why I bring the Ares Infrastructure Fund, which is a $525 billion fund, is because you don't want to invest all your money in me, because you have to invest money in other managers. That is where we talk about diversification by asset class, diversification by managers, and diversification by strategy, right? That is what we are offering here in this 75 minutes of presentation. All that we are showing you, whether it is public portfolio, whether it is alternative investments, or whether it is crypto fund, it is not just me or Anup or anybody on this call. It is a lot more bigger ecosystem than just those 2 or 10 people that you see on the public filing form, right? You pull a report from even UBS. UBS will have 20 advisors, but you would be working with one advisor, and that advisor may have X amount of experience. So what we are trying to offer here is the complete ecosystem. I hope that answers the question.
Yeah, thanks. So there are a couple of questions on Ares Infrastructure Fund, which I'll try to answer. One is it a monthly or a quarterly distribution? Ares Infrastructure Fund is a monthly distribution, and any tax document will be shared by Ares. Next are the questions with respect to the notes. Can you please explain what is look back feature and how does 10-day average help investors? Just to be clear, it is not the averaging as we explained in the slide. Kushbu, if you can bring up that slide if you can, otherwise it's okay. So the way it works is, as Sudhir mentioned, this particular fund is getting launched on the 14th. From 14th till 29th, the BBVA will be individually checking whether what would be the lowest price of Apple, Amazon, and Broadcom. It is not an average again. As of end of day, it is not that they're going to check every hour or every minute, but at the end of the day, they will check which is the lowest one. So as we give an example, assuming that on 14th of April, the Apple is at 180, and then it becomes 181 on 15th, and then probably on April 20th it becomes 170, and that is the lowest in the till 29th, then that is what it is picked up. Similarly, you do it for Amazon and AVGO. So this is a very good feature, and we have definitely negotiated with BBVA to get this one during this volatile time, right? Considering the interest of our clients. The next question is, why does note say
Anup,
flat or above?
Anup, I'll have to leave. I have to go for my next meeting, a lunch meeting.
Sure,
So
Sudhir.
please
Yeah,
continue. And if
yeah.
there are any questions for me, happy to answer that by email for any for the listeners. Yeah, thanks.
Well, okay. Thanks a lot,
Thank you
Sudhir.
very much. Yeah,
And
bye.
good day. Okay. So
Bye.
the next question is, why does the note says flat or above 100%? Again, this is just a nomenclature. When it says flat or 100%, again, if you take the example of Apple, which is priced at 170, so that is flat, or it is called as 100%. And if it goes above, it is above 100%. If it goes below, it is below 100%. So that is what it is called as flat or 100%. AAB snowball closes on 414. I don't think so. There is no time left to load the funds. 414 is coming Monday. Yeah. So basically, as we said, since there's a lots of volatility in the market, we could not get much time to launch because it is all timing. You can stay back on the previous slide. Uh, the the same slide, Kushbu, the one. Yeah, perfect. Okay, perfect. So that is the reason why it is launched on 414, and it's all because of the volatility. But having said that, if you already have the account open, then you can transfer the funds by end of day tomorrow, which is Sunday. Then we can place the trade for you guys. But please try to send the funds as soon as possible. Because of the volatility, we don't want the bank to restrict on the amount of investment amount. Next is, you had a principal protection structured notes few days ago. Are you able to comment on how you achieve no principal loss? Just wanted to get a better sense of your strategy since such products are rare. Yeah, that is right. We don't have the principal protected note all the time. It is more risk and reward. And again, it is not that MyTime Equity is issuing that. It is issued by the top banks like BBVA, BNP Paribas, Goldman Sachs. They are the one who bring up those principal protected note. But again, if you look from a risk and reward perspective, you see normally the principal protected notes are having lesser returns. For instance, the one that we had it on 11th of April had a principal protection, but the return was around 12.75. It's almost the half the one that you're seeing on the screen. So it's again a risk and reward model. And then, okay, what protection do we get for the funds notes you're selling if for some reason your company goes bankrupt or makes a huge trading loss, etc.? A good question, but it is just like we are we are an RIA firm. So just to draw an analogy, if you book your flight ticket to India with a travel agent, and let us say you're flying Air India, if the travel agent closes his business, you still have the ticket with Air India, right? So similar to that, it is it's a credit risk that you need to consider of the bank, and not definitely of the MyTime equity in this particular question per se. For Amazon, Apple, Broadcom, Note, the trade war is likely to affect all of these companies in a big way. How much do you think is a risk given that information? So again, please consider the duration that we have taken. It is the 5 years term that we have taken. Again, one thing we'll have to remember always, these are, at least these notes that you're seeing is for long term, and we have again worked with the bank to ensure that we get in at a lowest possible opportunity for each of these tickers that you see here. And secondly, we have also worked with the bank to ensure that these note is not called at least for 1 year, and after that there is an opportunity that for every 6 months, if all these three tickers are flat or positive, then you get the corresponding gains, right? So, and again, we all have to deliberate whether will the market, will these stock price be 40% down after 5 years. That is what we would need to sort of do a retrospection, and that is a risk that you'll have to do yourself, that homework you have to do it yourself and come back. Okay. I think yeah, there are a few requests for adding to WhatsApp and getting these recordings and asking for additional flyers. Please write to wealth at MyTime Equity. And okay, now there are two questions that we'll quickly take. What is the source? Retirement funds or non-retirement funds mean? It means that you can use your old 401ks, old IRAs, and it is that is what it means by the retirement funds. And the non-retirement funds is primarily it will be an individual brokerage account, but we can definitely talk more about it. I know it is almost 12:38 here in the US, so this is the last question that we will take. Anything is there, feel free to drop an email or call us, and we'll be more than happy to take those questions for you. Okay, that's it from my side, Kushbu.
Thank you everyone for joining the webinar. So now we will end the webinar. Thank you and have a good weekend, everyone.
Thank you, Kushbu. Bye.
Yeah.